If you're a trader, I would venture to guess that you really like catching big moves. We all do. So in this lesson, I'm going to teach you how to identify this spot and this spot on your charts, because if you could identify this spot and that spot correctly, guess what? You get to catch the big move that happens in the middle. Let's get into it. Let's say some really great news has just come out for your favorite stock, cryptocurrency project, or maybe the currency pair that you're trading. Great. What happens then? That creates demand in the market. The price goes up. But then what happens shortly after that? A lot of times the market will peak out and then it drops back and then it goes into this price consolidation phase, this kind of sideways market. This creates a lot of confusion for traders. They don't know if it's going to go up. They don't know if it's going to go down. It's just moving sideways. And a lot of times it leaves people trapped on the long and the short side. So the key is understanding what's going on here. How does this happen? If there's good news and so much demand has just come into the market, why all of a sudden is it stopping? The reason the market is stopping is because all this demand has to be filled by somebody. Who's going to sell to all that demand? It's the market maker. And because the market maker has sold to this huge spike in demand, it has caused the market maker to get net short. This is a big problem, because if there is truly significant demand that's going to carry this market for a while to the long side, the market maker is going to lose a ton of money. So how the market maker is going to fix this is with the strategy of manipulation. They've already got traders confused because they're suppressing price. They're not letting it organically move up with the demand. So that's already got these traders that have previously bought thinking, well, maybe there's not as much juice in this market as I thought. So all the market maker really needs to do to fix their problem of being net short is dump a little more supply into the market and get it to move away from this area. This right here is going to freak out the traders that are net long still. And then it's also going to cause new traders to start to sell the market, dumping even more supply into this situation. Now, what does that do for the market maker? In this area right here, it creates a ton of buying opportunity. What's the other side of a sell order? It's a buy order. So right here, the market maker can rebalance their portfolio, plus they can load up on new buy inventory, because guess what? They know that this demand will kick back in very easily. And how's that going to happen? All they have to do is they need to let the market come back up right about here. And then when we get over this equilibrium point right here, natural demand from the other traders, the retail traders, the public in general will kick back in at this point, and boom, we're off to the next move. So the key for you right here is understanding that the market maker is the one that controls the floodgates of supply into the market. Yes, the market will move up with organic demand, but not without the market maker's permission. So if you want to catch the big moves that happen in these big trending environments, you best understand where the market maker sits and how they're positioned. This is the formula for catching big moves. Step number one, first you want to identify a contraction box, which I'm going to teach you exactly how to do that in just a moment. You want to assume in this situation that that box is preloaded with strong demand. How do you do that? Well, again, we could look at, has there been any positive news that has recently come into this market where we've seen the market already start creeping up? You can look at the higher time frames. Are the higher time frames already pointed in the upward direction? Is there strong momentum on those time frames? The point is, when you identify this initial contraction and you map that out, you're going to expect that this is going to be a point from which the market maker will use to rebalance their portfolio. That moves us to step number two. When you see this happen, you see the market dip below this equilibrium point, you want to accumulate your inventory with the market maker, meaning you want to buy under this level. The reason that that's so great is because if you're wrong, let's say the demand doesn't kick back into the market, you're closer to your exit point. And if the demand does kick back in, which it's highly likely to do, then you're going to catch the majority of this move and be much, much better positioned for risk, which then leads us to step number 3, which is to sell your inventory with the market maker. The market maker is buying below because they know this is a discounted price. And then as the demand kicks back in, guess what? You got a bunch of retail traders flooding into the market and they want to buy. Who's going to sell to them? You are, along with the market maker. So you're going to accumulate inventory with the market maker and you're going to sell your inventory with the market maker. And then when you see the market go back into this contraction zone, you get to do it again. This exact situation played out today in the Euro USD currency pair. So just a little bit ago, we had non-farm payrolls come out. If you look at our daily chart right here, we've been long on ATS trend for several days. So we've been expecting the demand is going to come into this market. So if we go over here to our 30-minute chart, we want to identify that contraction phase, just like I explained on the board. Well, we see that we had one right here confirmed. So when we left that contraction phase, we can see that the market maker was net short to a certain degree. So they manipulated the market down here just a little bit and then boosted it back up through fair market value. And then you can see we kept going, and then boom, there's non-farm payroll as it released. And that led to a huge move. Now look where we're at this very moment. We are in a fresh contraction. So the question right now is, what is going to be the future outcome of this box that we're looking at on the 30-minute? Is this demand going to hold on the daily? And if we expand out of this box and then dip below this equilibrium point, what is the best thing to do? Is it to buy? I'm going to leave that to you. Now here comes the big moment. This is by far the biggest question that has been asked on YouTube in particular for my channel, which is, how do I identify the contraction phase? How do I draw that box that you're always drawing on all these illustrations? So I'm going to give you the formula right now, and it's actually very simple. I always define a contraction by simultaneous lower highs and higher lows, meaning kind of going into a wedge. In fact, a lot of traders will say, oh, that's the wedge pattern. You're right. There's usually a lot of contraction activity inside wedge patterns, but the key to doing it correctly is to marry it to the 3 market phases, which I talk about on all my other videos. So first, you want to make sure that you've had a trend phase already happen. You want to make sure that we've seen that traveling activity, because what happens after the trend phase is we go into the contraction phase, which is the first market phase. So when we see the trend phase, what we want to do is expect the contraction, and then we want to look for this exact price action, which is, here's the trend phase goes up, it pulls back. You want to look for a leg of price action that moves up that does not pass that high. And then you want to look for another one that does not pass that low. And then right here at that moment, it is confirmed. When you see that happen, you can now draw a box around that price action. That is your contraction phase. It does not need to be harder than that. You just need to make sure that they are distributed after the trend phase has already happened. And that's where the practice is going to come in. So I want to quickly go through a couple of charts and show you on the chart how to draw your boxes. So I'm looking at Tesla stock right here on the 30-minute chart. Obviously, it's been moving up quite a bit. So we're going to assume that that momentum or that demand will continue. So we want to mark out our contraction areas that are standing out to us. So I see one right here at the top. So I'm going to go ahead and grab a box right here, and I'm going to drop a box right over this price action right there. So there's a contraction area there. And then we want to keep that center point, which is about right there. We want to map that out, because if Tesla is going to continue to the upside, then we're eventually going to work our way back up through this value level. So also the market has temporarily moved down from that level. So remember, we're looking for disbursement between contractions. So we know that there has been a minor trend phase to the downside right here. So if I look in this area, where has the market compressed? Where has it met that contraction formula? I can see one right here. So right there in that area, that's a good place to put a contraction box. So we're going to look at that level right there, and we're going to put our fair market value line coming out of that contraction. That's going to be our other reference level. So in this situation, again, if we expect the demand to be moving up, you would want to buy under this fair market value in expectation that we're overall going to travel back up to the highest level of framework in this trend and then get a nice big move up through this level. So if you're buying down here, you would want to protect your profit when you get up through this level. So now let's take a quick look at pound USD. I've mapped out the last contraction phase on the weekly chart. So that's going to show us our general flow of money. You can see right now we have a few weeks that are going up. The question is, are we going to get up through fair market value? If the market turns and the candles turn yellow, good chance we're going to have more momentum away from this level. So we'll have to wait and see what happens. But right now, we are blue headed back up towards value. So if we look at our 30-minute chart over here, here's the last few contraction phases. We had one that came up right here. It expanded upward, came down, tests that level, went back up. We formed another one here. We have good disbursement between those contractions. So right now, the question is this manipulation right here for the market maker rebalancing their portfolio? Is this a good entry? If so, then the market really won't want to come back below this level. We would be expecting that it's going to hold above fair market value and revisit this high. However, the fact that we did have such an aggressive collapse back below value leads me to feel like this may be a reversal and the momentum is going to kick back into the downside over here on the weekly, but we'll have to wait and see what happens. So that's what I got for you today. Hopefully you learned something that you didn't already know before, and you could use these concepts to do better in your trading. So I want to remind you, at my website, tradeats.com, I have a full 8-hour course called the Master Pattern Academy. It's something that I recorded with our Inner Circle members, and it's really detailed. It explains everything about the methodologies that I teach. And the best thing is it's completely free. You can just go over to tradeats.com, go to our free stuff section, and enroll in the Master Pattern Academy. You'll be glad you did. I made it free. It's for you. Go take advantage of it. So that all being said, thanks again for watching this video, and we'll see you on the next one.